Folks, how we doing this day? This is Johnnie Bazemore, creative financer. My host will be here momentarily. My guest will be here momentarily. For this week, we're going to talk about that creative finances. We're going to talk about the space of the non-QM. Ford and Dalton's, he's a non-QM lender, president of IceCap. That he's going to do a little bit more of introducing himself and kind of going from here. With this non-QM products that they have, I mean, there are a lot of a range of it. How they work are different from every capacity of the lender. But the best thing about it, it's an alternate situation for funding for investors. This is what it's based upon. It's not based upon tax returns. It's based upon liquidity, and it's based upon experience. It's based upon credit score and the project that you're doing. As you see that almost a lot of banks do this non-QM stuff, but you got to find out who really has the appetite for it, who's really out there doing what's supposed to be done for it. And how do they do it? How do they meet those guidelines? What is the level of what they want to do? Is it going to be a good basis for the investor? And are they willing to, can they pay the loan back? So we go through the situation where we have folks that, buying these buildings that probably abandoned, as we used to call them back in the day, but they're empty. They fully gutted, but they need to be able to be rehabbed and bring them back to normal capacity. So when that happens, we have to find somebody that's willing to do it. What's the LTV, loan of value, going to be? You're going to hear that term quite a bit when he comes on here as well. For it. And how much are they going to lend on? Do you still have closing costs? Absolutely. You still have closing costs for it. You're still going to need some down payment. It's based on the amount of money we're going to need for these projects, for it. And it's got to be within reason. You can't buy a project. A lot of these non-QM lenders, you cannot buy a project for $2,000 and then think the bank's going to give you $100,000 for it, because it doesn't, it doesn't work like that. Their appetite is to see money in the game. That's why they'll probably do. You'll see most common 20% down, 100% on a rehab. What do I mean by that? If you're buying a property for $100,000, they're going to give you $80,000, and then whatever your rehab budget is, they're going to give you 100% of that based on draws. And so, based on draws means that you're going to outline a scope of work for them, and you're going to tell them in tiers what you're going to have done, so they can come out and expect. So they can go ahead and make a draw to you for that work to be done. And so you'll get 100% of that. Then you'll have closing costs, title fees, broker fees, bank fees, escrows, insurance, the normal stuff that you have when you doing these loans. You're going to need some building risks. And every lender have their own regulations of what type of insurance they want, what they want to have on it, what endorsements you're going to have to get. And you have to look at that as well. Every investor is different for those requirements. They might ask for more endorsements. They might ask for more coverage for the rebuild and stuff like that. Something else you're going to hear Dalton say when he gets on: experience. How experienced are you? Are you prepared to go out here and to rehab a building and know what you're doing without messing up the money, and they have to take the project over and find somebody to do it? So experience plays a good detail in this as well, as you would have your investors and your contractor or your architect or your engineer, whoever's doing your work there, your electrician, plumber, go out to that project with you before you submit your scope of work. that scope of work has to be detailed, because once we have it in, once we're doing this, this is what they're going by. They're going by what you put on that paper for them to do. For it. No deviations. If it is, you got to resubmit it. Sure, give a reason why we're redoing it. Good evening, Chuck, and let them know that, hey, it's something that we might have overlooked, or something that we can include in there for it. So you you're actually standing by what you're sending in. So I tell folks, when you're doing your scope of work, don't just go out there and estimate. Go with your contractors. So when they're writing that up, when they're doing that information, we will be able to get the loan done and get the project to the finish line. That's the whole goal, to get it to the finish line. We can fund it all we want. You can get the money, but if you don't get it to the finish line, we waste a lot of time, effort, and a lot of people don't understand. So these banks, they'll fall into a loop to where they don't want to lend with new investors. So experience is very important. If it's either you or your contractor have a history of experience, that is good. If you're JVing, joint venturing with someone to do these projects, make sure they have experience. You have a lot of people that put together that they do the project with someone else, or together. Let them go ahead and come through and show their experience. How do we know you have experience? What are they going to ask for with the experience? As most of y'all know, the basic thing is the HUDs that y'all did for the purchase, and the refinance, if you refinance the property to get it completed. But most of all, you have to have that knowledge that goes along with it, to where you close it out. You close the deal out. You made it happen. It was no hiccups there where you had to sell it prior, but it's consistent. And that history follows you. And the good thing about that history is, guess what? It can lessen the amount you have to put down for the next time. We have investors that do 10% down on investment property, but you're going to need to show like 10 or 11 in the next in the last 3 years or something like that, to where you've been doing it consistently. It's been happening. Your track record's outstanding. You closed, you sold, you did whatever to get that property over the hump to the finish line. And once it's over that finish line, you're able to say, okay, now this is where we're at with it. For it. This is what we're doing. This is how it's happening. As we see, Dalton's, he's just a little late right now because it's end of the month. They're closing loans, the investment loans, and he's stepping in there as a president to really work forth to get this done so those investors can meet those deadlines. And that is so important with getting these loans to the finish line. So we got experience, which can which can give you a better loan to value. And also we have some lenders that they might do 100%. Yes, 100% of your purchase and flip money, and you just have to come to closing with closing costs. So you have to think about what's the ratios in those. What are they doing? If you're 650 to 699, they might do 65% of the total loan of value. That means that if your house is appraised at 300,000, you have a purchase for 90,000. The rehab is 45,000, and your 65% of your after repair value comes in at 185. 100% right there. That purchase and that rehab is 100%. Get prepared. Hey, BB, good to see you. Get prepared for you for that as well, because that'll save you all that you do. So I'm just sending a link. So those those are things that happens in these to give you to get you to the best situation possible, you know, to get you where you need to be for these financing. How many investors would love to be able to get a property, know they got some experience in it, and they meet that 65 to 70% LTV on a purchase, and they got to just come to closing with closing costs, $10,000, $12,000. That's amazing, because 20% of 100 is $20,000. If you come in and closing on a deal with 12,000 and you're getting full money to rehabilitate that property, you are winning. You are over the board winning for it. If that now you got to look at this. Your credit score is 700 to 720. They'll do 70% of that purchase and rehab. 721 to 760, they'll do 75%. You're not getting no better than that right now. That's golden, because now we're talking about you're covering 75% of the purchase and the rehab, and you're just coming to close in with closing costs. Those are important for you to have and for you to do in this game. And the goal is, I tell everybody, OPM, other people's money, is how to get it done. You might see a lot of stuff on Instagram, YouTube, and all that stuff. It's a method to the madness, but the question is, do you understand how that works? Do you understand what's the criteria for it? So you have to have some good folks that know the business, know how the business works, know when the business is going to be productive for you, and to find those solutions. ARV is important. Got to have a good realtor with after repair value for your project. If you don't have that after repair value for that project, we have a lot of stuff going on that needs to be addressed before we even start to go forward, because that tells you really if we have a good deal. Some people would like to go down to 66% of after the repair value for the purchase and the rehab. That gives them a cushion for if anything happens. Everybody has downfalls, shortcomings in this rehab and in this whole situation, for it. But you have to be able to organize it correctly. You have to sit forth and put your best foot forward on it and understand what you're getting into. It can be a good game. It can be a bad game. Have people failed before? Absolutely. Have they came out of that failing? Yep. I'm for, because now they understand what it's called for. We even have some lenders that don't even do walk-in appraisals. Desktop appraisals still exist. Don't have to go to the property. Don't have to see it. And hey, how we doing, Nicole? For it, they don't have to see it, but guess what? They can get those projects done for by knowing the AVM, automated value system that they use, to where they can scout the area and tell you what the local values is in that area. Those are things that we have the lenders do to get these things done, to make sure that they're funding deals and to be able to see it, see the value in the property. Every property don't have the same value. Every property don't have the same mixture for what's happening. It depends what you're doing to that property. If I have the same square footage and I have a duplex here and I got a single family here, we're in the same ballpark. We split it up, but we got more value coming in because we have two rents if we're going to keep it versus just one for it. So you have to look at those as well when you doing these projects. So you talk about we're going to DSCR debt service coverage ratio, which focuses just on the rents. They focus on the rents of the property that you're renting. So if your rent is 1 to 1, I'll say 1 to 1, meaning that your rent covers the mortgage with the PITI in it, principal, interest, taxes, and insurance in there. You have a 1 to 1 ratio. If it's less, they start going in reverse. A lot of lenders don't want that to happen because guess what? That money has to come from somewhere to pay them the rest of their money. So they got to look at that person that they're lending, that investor they're lending this money to, and say to that investor, hey, investor, are you able to cover this $75 extra per month because your rent is only $800 and your mortgage is going to be $1,000, or your mortgage is going to be $895 or $875. Those things play a criteria. People say, how do they come up with that? You go by the rents in the area. Fannie Mae has a guideline. HUD has a guideline. Section 8 has a guideline. So you look at those guidelines and see what they're charging for those rents in those areas. And guess what? You come up with the value for that property. And the value for that property is going to give you the understanding of how much rent you're going to charge. Can you exceed that? You probably can exceed it, but we base it off the market rent there for what we're doing, and that's what we have to do, and go from there. So we have to keep those in line. Like my man Dalton coming through right now for it, but it's always important for that information to be known when we're doing these, and we got to have some liquidity, folks. Y'all might have money. We're buying properties. I gotta use the realization that you need money to purchase a property. You can't walk in there and just think that, hey, you're gonna use other people's money and they're gonna finance everybody, and they don't know you from a hole in the wall. They have to have the confidence and know the experience that you're able to get these deals done. For Dalton, can you hear us?
Yeah, I can hear you.
All right, man. Welcome, welcome. We just doing some homework here on funding. But Dalton, if you can give us a little background on yourself, right quick, so we can touch bases here.
Sure, yeah. My name's Dalton Harbin. I'm president of Bluefin Group, which is the
You're breaking up on.
can you hear me?
Yeah, I can hear you now.
Okay, yeah. So yeah, president of Bluefin Group, which is the wholesale division of Icelander Holdings, which is private equity firm based out of Manhattan that focus largely on originating and aggregating, commercial business purpose, 1 to 4 unit, multi-unit, mixed-use mortgage assets, and then securitizing those assets or managing the debt ourselves within our debt funds.
Oh wow! And Dawn, how did y'all get into this avenue? Non-QM is a lot new for some of our folks out here, but just tell us how we came to this point with that your group.
Sure. Well, I worked in the industry for 23 years. First started in just retail mortgage sales. Working in what was known as subprime back then, and conventional lending as well, and Alt-A lending. Kind of different connotation.
Yeah, you breaking up on us. Hello? Yeah, he might be breaking up a little bit on us. We losing him going in and out, but as you heard, he's they're based out of Manhattan. New York, and they do a lot of different projects. Are you there, Dalton? Yeah. Yeah. So, yeah. So, Dalton breaking up. He's coming back in. He might be driving, but it's an equity based group. They do a lot of projects that they're creative with their financing of what they do, how they perform, and how they get to the point of just being able to deliver a good product. A normal product, we've seen them close in 10 days for because the way they structure and their tool that they use when they see the deal from the front end, they already know where it's going to be at, how it's going to fund, and we're just going to take the fund. Um, Tell everyone that it has to be in the LLC. They fund in the LLC. Anything outside of your LLC, they're not going to be able to do it. You're going to have to get that LLC that you getting started. So I'm telling any investors out there, get your LLC. Look like Dalton's back with us. Yeah. Can you hear us, Dalton? Yeah. Hello. Yeah. So get your LLC. um, get it established, make sure that it's in good standing. For all those folks in Delaware, let you know that we had that June 1st cutoff date for our LLCs, that we have to make sure that they're established and they're up and running in good standing, because you're going to have a late fee right now if you don't have that for and for it. So these are business loans, as you'll hear them say, for investors. These are not your average conventional or residential and stuff like that. Can they be more detailed? They can be more detailed when it comes to the fact of showing that you have the experience, excuse me, and the liquidity that you need to go from there. Folks, we set up, and I work with folks to set up those lines of credit, to set up your liquidity, so you'll be able to know that they are available for you for funding, and that you can close with that. And if you're doing flips, it's a revolving use of money that you can use over and over again if you're flipping property, to start building up your own cash flow. A lot of folks come into this, and they see these videos about they don't have to have no money and stuff like that. But I'm just, the word to the wise is that you have to have money, you have to have reserves, you have to have some type of money sitting behind there, because so many things happens. And then you looked at a project, you didn't know that in this wall something happened, and now you got to rerun plumbing here, if you don't have a full good job, or you just noticed that the back of the house or the front of the house need to have, you thought it was just need to have railing, then you can just repaint the steps and kind of dab it up with a little cement and stuff when you need to replace the steps on there. You might have the wrong size steps inside the house. You might have cabinets and stuff like that that can come out. It's so many things that can happen for permits. You got to pay for permits and stuff. So you have to have some type of liquidity to have that. These guys at IceCap, that they were going to require that because they're turning loans over and over and over again, and they're making sure the investors are fully invested in these projects. They don't want to get stuck with holding the ball at the end of the deal when they didn't budget enough just to get a deal. We see a lot of folks cut their budget short so they can get a deal, when you can never cut your budget short. You got to have the money for what we're doing. I'm going to tell you right now, when the question, what's the minimum FICO score? That's so important. Um, and and the minimum FICO score that we want to have is 660. Um, 660 is the lowest. That's the mid score. That's not your top score. The mid score that we want to have. 680, 700, you're going to get a better deal when you have scores like that, 800, because guess what? We see that we have responsible folks dealing with their credit and managing it accordingly. So,
If you have multiple borrowers, we'll take the highest mid score of all borrowers too.
see, Don just gave us a little. He'll take the highest mid score of that borrower. So we have
So
to.
if you have an entity or an LLC or a trust or a corporation where there's multiple members and they're all qualifying on the loan, then we'll take the highest mid score of those borrowers. Or if you're just doing personal investing names and not in an entity, we'll take the highest mid score of the two borrowers. If you have other entity members that have distressed credit or have have slow pays on or credit cards or extended balances on credit cards, bringing their scores down, then you
Mhm.
always want to elect to have the best credit score member of that entity sign,
Right.
um, and leave the other members out. So we'll take the highest mid score, but they all have to be qualifying scores. Everyone that is going to credit qualify. So that's a minimum score of 660. So if we have three at 660 and one at 780, then we can use the 780 for the actual loan. But if you have three at like 580 and one at 780, then you want to leave the 580s off the actual loan and make them under 20% on the operating agreement so they don't participate on the loan.
Oh, that's awesome for it and stuff. And Don, what does the 780 to the 660 do for lending?
Uh,
Um,
so a 780 score is going to get you, anything at 700 and above is going to get you max leverage. 680 gets you there too, but the pricing is so high it's going to be hard for the DSCR to qualify because the
mhm.
rate's going to be so high. So anything 700 and above will get you max LTV. Obviously, as you ascend in 20-point increments from 700 to 720 to 740 to 760,
Mhm.
780 and above, the rates get better. But the leverage is, you're attaining max leverage at 700 and above. Um,
Oh, wow.
and
And what
anything,
kind of.
if it's, as soon as you go below 700, then, LTV is being reduced, loan to value.
Mhm, mhm. Tell us what's the minimum loan to value that y'all do, Don?
Well, the maximum loan to value, minimum
The
down payment,
maximum,
you
excuse
mean?
me. Yes.
Is yeah. So maximum loan to value is 80 LTV on 1 to 4 unit DSCR loans. On
Mhm.
2 to 8 unit mixed use DSCR, we do 75 LTV. On 5 to 9 unit residential,
Say that last part
there's
again,
no
Lord.
CD.
Yeah.
We
So
never
say that.
stress or season.
Mm. Say that last part again for us.
Season funds to close was important because investors are typically aggregating
Hmm.
assets. Not see where they come from is crucial. Create the capitals.
Okay. Yeah. Well, we got you a little broken up there, but we know that loan of value is so important.
Yeah, I'm just
We
yeah. Yeah.
Yeah, we got a question here. What is the after repair? What is the after repair value, and how do you calculate that on the property? So, so Dawn, we and what I like to tell folks is that we try to get comps in the area for the finished product of what it's going to be worth, and then we start calculating the after repair value. So after a building's fixed up in that area and
You're
the
doing
comp,
in flip.
say that again, you're going in and out.
Yeah, I'm not sure why the server. I'm not sure why the service isn't working, but
Yeah.
um, the hours after
Yeah, so yeah, his service, we having some problems with his service. My apologies to the audience for that, but the after repair value is so important here, to where you using that for your fix and flip products, for your debt service coverage ratio, is based upon the rent rolls in that area for that to repay. So how do we explain after repair values? I have a triplex here that's totally gutted, needs a whole work, needs to be realigned again, and I have to go there and see what triplexes go for in that area. Once they're fixed up, once they have the same square footage and everything, and say, hey, my after repair value on this triplex in Newcastle, in this area of Newcastle County, is $450,000. So we know that's finished. Dalton, you back?
Yeah, I'm not sure what's going on. I keep cutting out here, but
Yeah, for
I
this stuff.
I,
So
I think this platform you're using requires a lot of internet or service, which I don't have unfortunately right now.
yeah, for and that's okay. Um, so tell us some of the programs that y'all really specialize in, Dalton, and what makes y'all a leader in that area, you believe?
So what I was saying before is we don't source for season funds to close, so that's important for
Hmm.
real estate investors.
Hmm. Yeah.
We
So
specialize in the bridge to term space, so bridge and flip, fix and keep, renovation, construction, and then DSCR term takeouts for those same assets.
and that's huge for any investors here. You don't need seasoning on your closing funds. For that, a lot of other banks going to want you to have some seasoning on funds that you're using for closing, and they want to know where it came from. It has to be sourced and all that stuff. IceCap allows you not to have to worry about seasoning of those funds. That's something that you have to take into consideration, where that can hold up a deal right there, for
Yeah,
if you wait to have that.
and we also allow up to 20% assignment fees, up to 3% seller concession. Um, so we're pretty flexible when it comes to investor schematics. A lot of these assets that investors are buying are on wholesale assignment contracts. We see
Hmm.
them frequently, so we'll allow up to 20% fee to the wholesaler, um, which
Oh wow,
is which is definitely
it's
enticing for investors that are working with wholesalers a lot, who are sourcing the properties and obviously taking an assignment fee for securing that asset and getting it out of the market.
wow, and that's amazing because we have some wholesalers out there that do a lot of deals with these investors to find them deals, and that's big. 20% is quite a bit of money for it. So if you have $100,000 loan and that wholesaler wants $20,000, IceCap's going to let you go ahead and do it, for it.
Yeah.
So
So
that's not.
anything up to 10% is one appraisal. If it's a 20% assignment fee, 10 to 20, we do need two appraisals. So that's the one caveat, just to make you
Mhm.
aware.
Yeah.
Um,
Yeah, two appraisals
yeah,
for.
anything over a 10% assignment fee up to 20.
Mhm. And folks, that is huge in this market, um, for the wholesalers to make their money. So and that's a question that these wholesalers need to know. Um, can my assignment fee be added? Can I show that, or how can that be on the settlement sheet for it and everything? It's a huge opportunity to for them to make money as well and everything. But
Yeah.
um,
When it
um,
comes to fix and flip lending, we generally anything from 0 to 2 experience, so up to 2 execution in the last 3 years is 25% down. So that's flipping or keeping a property after renovation, and then anything 3 down to cover 100% of the rehab. So if you have 3 experience in the last 3 years in renovation, renovating properties and showing successful exits.
yeah, Ford and stuff. That's good. Hmm. Hmm. Folks, so we were talking about experience in the beginning. Yeah, yeah. So you broke up a little bit, but we were talking about experience in the beginning. Experience is important, as you heard Dalton say that. As with that experience, you have more leverage to really do a better deal, or you can kind of have less you bring to the table for that experience type of circumstance and situation. For and Dalton, what states do y'all lend in?
We're in all states except for South Dakota, North Dakota, Vermont, Alaska, Idaho, Utah, and Minnesota and Oregon. But we're working on Oregon right now and Minnesota. Um, but every state besides that, we're licensed in, and you don't need licensing in those states to lend in those states with us.
Oh,
But
nice, nice.
yeah.
For it and stuff. And do y'all have a maximum loan amount too?
Um, Depends on the product type. A 1 to 4 unit single asset loan, so not like a blanket or portfolio DSCR. We're doing up to 3.5 million. Um, on the 5 to 9 unit or 2 to 8 unit mixed use, we're doing up to 2 million. On the blanket portfolio, where you can do up to 25 properties in a single mortgage, um, that's 6.25 million, and that goes to 80 LTV also, so you can get high LTV and high loan. That's for 1 to 4 unit properties, condos, townhouses only. But that's probably our most popular product is the portfolio product. A lot of investors come to us, through brokerages, obviously to secure up to 25 properties at once in a refinance or purchase.
Hmm.
Um, yeah.
What is the benefit of that? What's the benefit of that, there, Dalton, of them doing that?
The benefit of doing that is, it's ease of use. You get single escrow account, single payment, single underwrite. You save a lot in underwriting fees. So, it works in 4 property increments from 2 to 25 properties. So as you ascend in 4 property increments, the fee changes. But say you're doing 25 properties in a single mortgage purchase with us, 80 LTV, $6 million loan of 4 unit properties, you're only going to pay a $6,100 underwriting fee. Or if you did 25 properties individually, you're paying $1,595 per property.
Oh,
Uh,
wow.
so so ostensibly you're saving like $35,000 in underwriting fees.
Wow. That's a lot of money there, for it and stuff. And what about the rates
So,
for
and
those?
the rates are very similar to single asset rates. We underwrite them in one business day, just like any other loan. So 1 business day turn times from initial submissions to condition, submissions to us. Once you get the approval, you can close same days, clear to close on all of our loan products as well. So there's no, waiting at all. Once it's cleared, you close. But the rates are maybe an eighth spread, difference between single asset loan rates. Um, and the benefit obviously is you're getting high loan amount, and high leverage as well. So whereas if you want to buy, again, $8 million pack of 2 unit properties, well, we can go to 80 LTV on that. So it's
Mm,
pretty significant. And also, again, it just, the single escrow, the single payment, organizing it for the borrower, so they only have to worry about mitigating 1 payment instead of having multiple debits out of their account on a monthly basis or sending checks out physically. And you can also carve properties out of the portfolio.
mm.
Um, so if you have 20 property portfolio with us and you want to sell or refinance one out of it, you can do that as well and still keep the mortgage.
Oh,
Um,
wow.
yeah, so it's a flexible product also. So definitely, um, it's something that's salient for a large multiple door real estate investor, um,
Mhm.
looking to access equity from property in a refinance or acquire properties. You can go to 75 cash out, just like a single asset loan, or 80 LTV purchase.
Oh, wow. That's good to know. For
And
that.
you can also get more cash in hand too. Whereas like on single asset loans, you're capped at actual cash in hand. Portfolio loans, you can go up to 1.5 million cash in hand on cash outs. So
Oh, okay, okay, okay. Yeah, that's pretty popular, especially when you buying portfolios and if you're buying somebody's portfolio to try to get it all in one whop and save some money there instead of
yeah,
doing it
you get a
to.
single title. The only difference is a single title policy and deed of trust with all the addresses listed on it, and there's a single approval with all the addresses listed on it.
Mm. So you mentioned something about you can take one property out of that blanket if you need to do
Yeah,
something. Um,
yeah, you
and
can take a property out at 120% of the allocated loan amount.
oh,
So every property in a portfolio is going to have an allocated portfolio LTV. But if the portfolio $300,000 and it's a 75 LTV portfolio, then your allocation per property is going to be 225,000, right? Because they're all worth 300 grand, and 75 LTV or 300 grand is 225. So that means there's the allocation for every property will be 225. So that means we'd take 120% of that 225. The extra 20%, whatever the unpaid principal balance is, of course, at the time of payoff. The extra 20% over it that's taken reduces the rest of the portfolio principal, and then we recast the loan and a new payment, new note is sent to you.
oh, okay.
So it's at so the carve out of the property is at 120% of the allocated loan amount for that property.
Yeah, for it. And can you take that money out just to go purchase another property and do another loan or
Yeah, you can't add properties to a portfolio, but you can take them out.
okay. Good. That's good. That's good to know. Tell us about your fix and flip product that you have.
Johnny.
Yeah,
I
can you
said,
hear
yeah,
me?
you can't add. Yeah, you can't add, you can remove.
Yeah. We got
And
that.
then then people be taking use a DSR as a rental loan.
Mm-hmm. Mm-hmm. Yeah, for it and stuff. So you can take them out.
Purchases.
Yeah, you can take them out. You just can't add them. Tell us about your fix and flip product.
That's what I was saying before. Where 3 plus experience, 10% down up and cover 100% of rehab. We do heavy rehab, light rehab. Light rehab is going to be qualified budgets at below 50% of the as is value, so the current value of the property. Heavy rehab is going to be budgets in excess of 50% of the current value of the property, or changing the use of the property, or increasing the square footage by 20% or more, and then it'll be considered heavy rehab. But
Okay.
light rehab loans, which is the majority, light rehab, which is the majority of the loans out there, is as little as 10% down to cover 100% of rehab with 3+ experience.
Oh, yeah, that's real good. Heavy rehab is over 75,000. Is that the dollar value, basically?
No, 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 no. Heavy rehab is just more than 50% of the as is value of the property.
Oh, okay. Okay.
You buy it for 200,000, your budget's 125.
Mm-hmm.
75,000, then that's still light rehab.
Okay. 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 So yeah, that makes sense for that heavy rehab. And and tell us how sometimes we have these investors that the purchase price exceeds the rehab value
Yeah,
exceeds the purchase price.
if the rehab value exceeds the purchase price, the actual budget being used, then that's going to be considered heavy rehab.
Okay. Heavy
Um,
rehab. So folks, y'all
and
y'all
that,
got that now.
yeah, yeah. So basically, then there's ground up construction, obviously, as well, which is totally different. But as long as your budget is, below 50% of the as is value, so um,
Yeah.
so three experience is 10% down for 100% of rehab at 9.5 rate. 10+ experience is 10% down for 100% of rehab, and that's at 8.99 rate, and that's for a
That's
12
great
month.
rate.
Yeah, yeah, and that's 12-month interest only loan, with no prepay penalty, and it's non-Dutch interest. So non-Dutch interest means that you're only paying interest on the initial loan amount that's funded at the table, and then as you draw down from the construction reserve that'll be issued to do the work, then you'll pay additional interest on those monies that are accruing on the principal balance. Some lenders that are renovation lenders are Dutch interest. So that means they're charging interest on the entire amount that's being issued at the closing table, their initial loan amount off purchase price plus the budget, even if the borrower hasn't used the budget yet. So it's important to notate that non-Dutch interest means you're only going to pay interest on what you're actually using.
Oh, that's good. That's good.
Yeah.
That makes sense for it because we see that quite often with that Dutch interest and stuff, and a lot of investors are like, man, what is that? you know,
Yeah. Hmm.
um, or and the benefit of that is just to you don't have a heavy monthly payment, folks, that you're gonna have to pay each month on while you try to rehab this property.
Yeah, your largest payments are going to come towards the end of the project when you're almost done and you're exiting it. So,
Mhm.
when,
Yeah, and there's no prepayment penalties if they finish before that 12 months, right?
exactly, yeah. So,
Mm-hmm.
if they finish early, they can exit the loan early.
For it and stuff. And will y'all be, if they doing a buy and hold, will y'all be able to do that refinance to flip them to a 30-year DSCR?
Yeah, we have 30-year DSCR. So, once they're done, the broker would come back to us, the client, because we just deal through wholesale channels, brokers and lenders only. We lend to. So once we do mitigate the asset while it's in rehab, obviously we're issuing draws to the borrower and getting the inspector out there to make sure the work's done. But once it's done, the borrower comes back to us for a refinance. We send them right back to the broker to submit a refinance to us into a 30-year rental loan, which are obviously the no income doc loans you've been discussing.
Yeah, for it. And that's key with these loans here because we noticed a lot of people suffered with those tax returns during COVID and stuff, and we had to figure out. I'm glad Ice Cap and a lot of these lenders, they figured out we're gonna have to try to do a little something different to still keep our investors around.
Yeah, I mean that's what DSCR loans are great because it's TRID lending, conventional TRID lending or non-QM TRID lending is all about the borrower's ability to repay the debt, whereas DSCR lending is all about the asset's ability to repay the debt. So we're looking at how the property cash flows, and that property's cash flow can cover the monthly payment that we're issuing on the property.
Wow. And for your 30 years, tell us what kind of rates can they vary from, because we hearing some low
Um,
rates on your fix and flips.
yeah. So that's all. Yeah. I mean, fix and flip again starts at 8.99 and goes to 10 and a quarter, depending on experience and heavier light rehab. Um, as far as DSCR 30-year fixed rental loans, that's that's dependent on asset class. So the type of property it is, and that's at um, it starts, or I think the bottom of our rate stack starts at 6.25 and can go as high as into the eights, depending on the LTV and credit score and DSCR and prepay penalty. So the things that are going to drive the interest rate. Whereas like on fix and flip lending, what drives the interest rate and down payment is purely experience and of course the type of property. When it comes to DSCR lending, what drives the interest rate is going to be the DSCR ratio, so how much the rents are covering the mortgage payment, the actual credit score, the LTV on the property, and the prepay penalty on the property as well. So DSCR loans carry prepay penalties. You can go down to zero if you want. Obviously, the rates are higher, but you can go all the way up to 5-year prepay. So if you have a 5-year prepay, you're going to get the best interest rates, obviously. So all those things, conjoin to yield what the rate's going to be for that scenario. So if I'm pricing a 75 LTV, 5-year prepay, fixed prepay, purchase on a single family property that's covering at 125 DSCR with a 760 score, then you're looking at rates like, in the sixes, obviously. But if you're doing this,
That's amazing.
conversely doing a 75 cash out,
Hmm.
covering at, 1 DSCR and you're doing no prepay at all and you've got a 700 score, not a 760, then your rate's probably going to be in the mid to high sevens. Um,
Hmm.
so these are
And
all,
that's amazing still, because conventional rates are 7%.
yeah, yeah, yep, yep,
For it. So, folks, I mean, you talking about some good numbers when you talking about rates. He was talking about 6.25. I mean, you got FHA rates at 6.25.
yeah,
For
yep,
it, and these are investment properties, no doc that folks might say it's a 5-year prepay. 5 years is not a long time to hold on to a property. I mean, if you're going to save that type of money for it, and you gotta look at that investment. If it's a long term rental and you have a rate like that, you hold on to it because you're
yeah.
not going to save two
You want to
percent.
look at your time horizon in the property and what your goals are with that property. If you're throwing in a portfolio for cash flow and plan on holding on to it for again cash flow and equity appreciation purposes, and you want to do a cost benefit analysis. Okay, well, if I take a 3-year prepay, I'm going to get a 7% rate. But if I take a 5-year prepay, I'm going to get a 6.75% rate. And
Mm-hmm.
that quarter percent difference is going to be $100 payment difference. So that $100 payment difference, compounded over a 5-year period, well, then you're talking, at 60 months times 100, so you're talking $6,000. So does that payment savings, is it worth it for me? Um,
Mm-hmm.
so that's what you want to do when you're analyzing whether you want to go into a prepay or not, because a prepay is obviously something to factor in when if you have a shorter term time horizon on a property and you're looking to just hold it for 2 years. So you want to tailor the prepay to what your goals are in the property from a time perspective.
Yeah, and we seen Kevin out there. He's coming in the game, and I like to let folks know that hey, it's some excellent products out here. I wanted to introduce y'all to IceCap because I just know some of their rates are the lowest that you're going to see for these investment properties.
And
And
also, one business day turn times. I mean, we averaged 9.26 days from submission to close last month on DSCR. So, as quickly as brokers always come to us and say, how quickly can you get, can you close this? And I say, as quickly as you can send conditions, and we're one business
right.
day every time. So it's like get us the conditions. You're going to get a review in one business day every single time. Or a lot of lenders are nowhere near that turn time. And I have many
None.
brokers. I just had a new loan from your company, Johnny. E-mortgage, and he sent his first loan into us. He's like, "Oh, you're the only 5-star rated lender in our system, and I'm going to send you a
Yeah.
DSCR loan because everyone says you guys are
Yes.
fast." It was David Wright. He sent the first
Yeah.
loan into us. It closed in 7 days. He was blown away, and
Right.
he said, "All right, I got more loans coming to you."
Yeah.
So
Because you can't meet that time. You're meeting the customer's expectation. You're getting a
well,
good
yeah.
rate.
Investor lending, it's like you're dealing with people's actual livelihood, and
Right.
people are doing this because this is their income, and like they need to get these properties in and out of the market quickly. They don't want to lose the contracts, and so the quicker you can operate and more efficient you are, obviously, more proclivity the broker's going to have to bring more and more clients to you. So that's why we've developed proprietary technology. Our portal is very easy to price and work it and submit loans, and our underwriting schematic, one business day turn times. All of our underwriters are trained, from the ground up by us, to execute and make sure they stick by those turn times on a daily basis. So, and that's, it's really crucial to our business model.
Yeah, for them in Spain just came. I'm telling all y'all investors right now out here, we talked about timing and making stuff happen. You heard it here, firsthand that it's available, it's here. Make sure you don't have to have seasoned funds. We're not looking back at your tax returns. We're making sure that we have a good deal when we're submitting this deal. We're making sure that it makes sense to the investor as well as the bank, so we can submit some deals that are truly going to be in the wheelhouse of what we need to do. If you're building that portfolio and you're looking to do it, IceCap, we have the products, we have the stuff available. As you say, they're the only 5-star lender on our platform for it, and that's what's amazing for it, because you can see that every other lender, they might have some hiccups here, but when you get a 5-star, what you're dealing with and making it happen. Folks, I thank y'all again. Dalton, I thank you for taking the time out. I know it's the end of the month, and I should have thought about that,
No,
inviting
it's
you.
totally fine. Well, what I didn't think about, and I apologize, Johnny, is that
Yeah,
we're also at the National Private Lenders Association conference, and half our company's at it. So I'm wearing 15
oh,
different hats this week.
yeah,
um,
for this
um,
stuff. But we definitely got to bring you back again.
yeah. Let's come on again. I appreciate you having me, and I hope to do some
Yeah.
more business with you soon.
Absolutely. Thank y'all again.
All right.
We will definitely catch up with you. This Creative Financing with JB. We will definitely see you next week, and y'all have a great evening.